All right, so today we are cracking open, once again, Benjamin Graham's The Intelligent Investor.
A classic.
It really is. And specifically, we are taking a deep dive into Chapter 4,
Okay.
where Graham lays out his blueprint for building a defensive portfolio that's built to last. And you want to understand how to apply these principles,
Absolutely.
especially when it comes to balancing bonds and stocks. And honestly, who better to guide us than you?
Well, that's very kind.
Hmm.
Let's hope I can live up to that.
I think you can.
Graham is considered the father of value investing for a reason, right? His ideas are just as relevant today as they were decades ago.
Totally. He wasn't about chasing the latest fads.
Right.
He really focused on understanding the intrinsic worth of a business, which is a pretty solid strategy when it comes to navigating the ups and downs of the market, right?
Absolutely. And that's exactly what we're going to try to uncover today, those core principles that can help you build that resilient portfolio.
Perfect. So let's start with Graham's definition of a defensive investor. He's pretty clear that this chapter is for those who prioritize safety and peace of mind over, shooting for the moon in terms of returns.
Mm-hmm.
It's about sleeping well at night, knowing your investments are rock solid.
Absolutely, exactly. He distinguishes between defensive and enterprising investors based on how much time and effort they're willing to put into managing their portfolio.
Right.
But here's where it gets really interesting. Graham actually suggests that finding those undervalued diamond-in-the-rough stocks, those trading for less than their intrinsic value, might actually be less risky than holding what are considered super safe bonds.
Wait, really? That feels kind of counterintuitive.
Yeah.
Most people think of stocks as inherently more risky than bonds.
I know, right? But Graham kind of flips that on its head.
Okay.
He believed that by focusing on businesses with really strong fundamentals, but, perhaps temporarily undervalued by the market, that you could mitigate risk, even when things get a little volatile. It's all about, buying $1 for 50 cents, which is like a very central theme in value investing.
Okay,
Right.
so you're basically saying that finding those hidden gems, those undervalued companies with solid potential can actually be a less bumpy ride than sticking solely with those supposedly safe bonds.
That's the idea that he's proposing, and it was challenging conventional thinking even back then.
Wow.
And this leads us really to his core recommendation for the defensive investor. Finding that sweet spot when it comes to your bond stock allocation.
Okay, let's unpack that. The bond stock allocation conundrum.
Yeah, the bond stock allocation. So Graham proposed a portfolio split between high-grade bonds and high-grade common stocks,
Okay.
suggesting a range of somewhere between 25% to 75% in either asset class. So
Pretty broad range.
pretty broad range.
Yeah.
He offered a 50-50 split as a good starting point.
Okay.
But, sticking to any predetermined allocation can be tough.
Oh, tell me about it. It's like we're wired to buy high on excitement and sell low out of fear, like the exact opposite of what we should do.
It's so true. It's human nature.
It is.
But what's really fascinating is that even big institutions, those with teams of analysts and supercomputers,
Right.
they struggle with this too.
Really?
Oh, yeah. Graham recognized that even the smartest people, can be their own worst enemy when it comes to investing, which is why he stressed a disciplined approach.
Which brings us back to his 50-50 formula.
Yeah.
It sounds deceptively simple. What's the logic behind it?
I think it's elegant in its simplicity,
Huh.
Graham designed it to navigate the market's inevitable ups and downs. So imagine this. When your stocks rise, pushing their share of your portfolio to, say, 55%, you sell off a small portion and you move those proceeds over to bonds.
Right.
If stocks dip, bringing their share down to 45%, you do the reverse.
Gotcha.
You use some of that bond money to buy more stocks, and this automatically helps you buy low and sell high, bring that balance back into check.
So it's like a self-correcting mechanism built right into your investment strategy.
Exactly. It's like having a financial autopilot to help you stay the course.
I like it.
It's worth noting that even institutions, known for their investing savvy, have experimented with and sometimes moved away from similar formula-driven approaches. Take Yale University, for instance.
Oh, right.
They followed a formula for years, aiming for about 35% in common stocks, but by the late 1960s, their stock holdings had crept up to 61%, a pretty significant jump.
It just goes to show, even the pros, they can be tempted by a bull market.
Oh, yeah.
So is Graham saying we should just blindly follow this 50-50 split no matter what?
Well, not necessarily. He wasn't about rigid rules. He emphasized that it's not a magic bullet. And other factors come into play, like what's happening in the market and your own risk tolerance, Back in 1972, when he was writing, bond yields were much higher than what we're used to now, which made them a very attractive option compared to stocks.
So how did he factor that into his recommendations? Would he have suggested deviating from that 50-50 split in that environment?
You bet. He recommended what he called a cold-blooded approach, suggesting investors wait until the dividend yield on the Dow Jones Industrial Average was roughly two-thirds of the bond yield before moving to that 50-50 allocation.
Okay, I'm intrigued. Cold-blooded sounds intense. Can you break that down for us?
Imagine this. It's 1972. The Dow Jones Industrial Average is sitting at 900 and dishing out $36 in dividends per share.
Okay.
Graham suggests that investors wait for either bond yields to drop substantially, say from 7.5% to 5.5% without stock returns changing, or for the
Yeah.
Dow to slide down to 660 with steady bond yields and dividends.
So it's about recognizing the relative value of each asset class, not getting fixated on a specific number, but understanding the bigger picture of how they stack up against each other.
Exactly. It's about being patient and letting the numbers guide your decisions.
I like that.
Now, once an investor has kind of weighed these factors, the next step is to actually build that bond portion of their portfolio.
Right.
And Graham gets into the nitty-gritty of different bond types.
Okay, let's dive into that. He starts with U.S. savings bonds,
Mm-hmm.
specifically Series E and Series H, right?
Right.
They often seem like, the quiet workhorses of the investing world.
They really are, and Graham considered them a boon to investors. Back then, he was particularly drawn to their safety. You're guaranteed to get your principal back, plus interest, which was especially appealing during those uncertain economic times.
Right. That sleep well at night factor, definitely worth something. But he doesn't stop at U.S. savings bonds. He also talks about other government bonds, right?
He does.
What's the story there?
He talks about the wide range of U.S. bonds available, each with different maturities and coupon rates, and of course they are backed by the U.S. government.
Right.
What I find really interesting is his take on what were called indirect government obligations.
Indirect government obligations. Okay, that sounds a bit complicated. What exactly are those?
So think of them like bonds, but instead of being issued directly by the Treasury, they're issued by government agencies or entities that have the backing of the U.S. government.
Okay.
And Graham noticed that these often offered better returns than direct U.S. bonds with similar terms.
So even though they weren't technically Treasury bonds, that government backing made them just as secure.
Exactly.
But why go through the extra steps? Why not just issue more Treasury bonds directly?
Well, that's where things get a little political.
Oh.
Graham suggests that it was a way to work around the debt limit Congress placed on direct government borrowing.
Oh, interesting.
Essentially, these indirect obligations were a way to raise capital without technically increasing the national debt.
A loophole that savvy investors could use to their advantage.
Exactly.
It's like a real-world example of how understanding those little nuances in government policy can really give you an edge.
Absolutely.
So after covering those government-backed options, does Graham venture into the world of corporate bonds?
He does. He acknowledges that corporate bonds, while subject to taxes, can sometimes offer higher yields compared to their government-backed counterparts.
Of course.
However, he also throws in a word of caution, particularly for our, defensive investor friends.
Because as we all know, higher yields often come with higher risks.
Exactly. He was wary of investors, especially those prioritizing safety, getting seduced by those juicier yields without fully grasping, the potential downsides.
Right.
He believed that while high-yield bonds, often called junk bonds, might offer attractive returns, they need a different kind of expertise and risk tolerance.
It's easy to get caught up in chasing those bigger numbers, but Graham reminds us to align our investments with our goals and our comfort levels.
For sure.
So with bonds covered, does he move on to other fixed income options like preferred stocks?
He does, but not without, I think, a healthy dose of skepticism.
Okay.
Graham viewed preferred stocks as kind of inherently flawed, despite acknowledging that some could be good investments.
That sounds a little contradictory.
It does, doesn't it?
Why the wariness toward preferred stocks?
It all comes down to their place in a company's capital structure. They're kind of stuck in between bonds and common stocks.
Okay.
And in Graham's view, they don't quite offer the best of either world.
Interesting.
Preferred stockholders, they're entitled to fixed dividends.
Okay.
But their claim on those payments, it comes after bondholders and before common stockholders.
So if a company hits a rough patch, preferred dividends are the first to get cut.
Yeah, they lack those ironclad guarantees of bondholders, and they miss out on the potential upside enjoyed by common stockholders if the company thrives.
Right, they're in a bit of an investment no man's land.
They are, and Graham highlights how this vulnerability often shows up during economic downturns.
Okay.
He argues that only a select few preferred stocks are strong enough to keep their appeal when things get tough.
So when does he see preferred stocks as worthwhile?
He believes the best time to buy is when they're trading at bargain prices, driven down by, say, temporary setbacks or a gloomy market outlook.
So spotting the diamonds in the rough.
Exactly.
But that approach might be more suited for an investor with a higher risk appetite than our defensive investor.
Yeah, that's a good point. It's
Yeah.
really important to know yourself as an investor.
Absolutely.
Now, you mentioned earlier that he touches on some less common investment vehicles as well.
Right.
One is convertible bonds, which, we cover in another episode.
Right.
He also mentioned something called income bonds. These are interesting because their interest payments depend on the company's earnings.
So if the company isn't making money, investors don't get interest. That sounds a little shaky, especially for a defensive investor. It does sound a bit riskier. It's like those bonds come with an asterisk.
Right, and Graham acknowledged that income bonds are often linked to companies facing, maybe some financial difficulties. But
Okay.
here's where I think his contrarian thinking really shines through.
Okay.
He suggests that despite that association, income bonds could be structured to benefit both the company issuing them and the investor.
Interesting. So he's not writing them off completely. He's saying that with the right terms, they could be a viable option.
Exactly, and it speaks to his broader point about not being afraid to, question conventional wisdom and explore investment options that might seem a little unconventional at first glance.
Right.
Sometimes those best opportunities are found in those unexpected places,
Yeah.
but you have to keep an open mind.
That's a great takeaway and a perfect example of Graham's approach. So as we kind of wrap up our deep dive into Chapter 4 of The Intelligent Investor, what are the key things our listeners should be taking away from this? What should they be thinking about as they build their own defensive portfolio?
Well, I think above all, Graham's message is about balance, discipline, and taking that long-term perspective.
Mhm.
He reminds us that building a resilient portfolio, it isn't about, chasing the latest hot stock tip or trying to time the market perfectly.
Right.
It's about understanding your own risk tolerance, diversifying your investments, and then, staying the course.
Yeah.
Even when the market throws those inevitable curveballs our way.
It's like he's saying, keep your cool, stick with the plan.
Exactly. His 50-50 formula, while not, a one-size-fits-all solution, offers a simple but effective framework for maintaining balance and resisting those, impulsive moves that can really hurt us in the long run.
That timeless wisdom is such a big part of why his work still resonates with investors today.
Yeah.
He doesn't just tell you what to think. He teaches you how to think like a savvy investor.
Mm-hmm.
Any final thoughts for our listeners before we sign off?
I think Graham's observations about income bonds actually are a great point to end on.
Okay.
His willingness to see potential value, where others saw only risk, I think, reminds us that we should always be open to questioning those assumptions and looking at things from different angles, The next great investment opportunity could be hiding in plain sight, but we have to be willing to see it.
I love it. Such a great point to end on. So thank you. As always, this has been another insightful deep dive.
My pleasure.